Small cap stocks could finally have their year in the light in 2024. The S&P 500 and the NASDAQ keep hitting fresh new all-time highs. The S&P also just breached the 5,000 level for the first time in its history, which is not only a significant psychological level, but also an important indicator of where the economy is heading. And that indication is the fact that the underlying strength in the labor market is indicative of us potentially bypassing a recession that many analysts had predicted for the next 12 months. And through a byproduct, what this is translating into is a record level of divergence between the performance of some of the biggest to biggest companies and some of the smallest companies in North America. Something called breadth has been missing from the stock market rally over the past 12 months since the S&P 500 has been hitting new highs. And as it turns out, there's good reason for that. And also, there's good reason for us to believe that breadth could flip sooner rather than later. A flip in the breadth of the market could result in even the mid to small cap stocks, which have been destroyed for the past 2.5 years, to rally in the same fashion as we're seeing with the likes of Nvidia, Meta, and all the other large cap tech stocks aside from Tesla. And to truly understand the severity of the situation, folks, the first thing we need to look at is just how well the large cap indices have been performing for the past 12 to 18 months. As you can see, folks, this is truly uncanny outperformance from some of the biggest of biggest names over the past 1 year. Since Feb 9th, 2023, Nvidia shares are up more than 235%, whereas the S&P 500, which is driven by something like Nvidia, Meta, Amazon, or Google, is up 22%, which is an extremely abnormal return during what many people call is a recessionary inflation period. However, meanwhile, in that same time, the Russell 2000 small cap index, which comprises of companies that are less than a $5 billion market cap, has been in a bear market and hasn't seen any light of day, with most of its stocks still sitting below their 50-day moving average and still hitting new all-time lows. As a matter of fact, this isn't just restricted to the Russell. Even for the other 493 companies in the S&P 500, they are still hitting or are near their 52-week lows, unlike what the index might be suggesting. And as you can see here, highlighted by all the yellow boxes, this event has really never happened in modern stock market history, where there's significantly declining breadth, but the index, as you can see, is actually hitting 52-week highs. And this potentially is actually good news for certain selective stocks. The fight against inflation, folks, has clearly, in my opinion, been won at least 75% of the way. Non-farm payroll employment data is showing us that the underlying economy is extremely strong, and although tech jobs are still at a loss because of extreme overhiring during the pandemic, those in the white-collar workforce and those on Main Street are still making a lot of money and have a lot of savings to play with. As a matter of fact, the median wealth jump from 2019 to 2024 for most people has been anywhere from 40 to 50% of an age group between 25 and 40 years old. However, because an acceleration of this kind of wealth creation would be a bad thing for the economy in the long term, the government obviously wants to slow it down in the short term. And that is exactly why interest rates have been raised and exactly why so many companies have been struggling, apart from the biggest of the biggest. And that, folks, is exactly what is immediately represented in the performance of the Russell 2000, which is significantly more sensitive to the economy in the short term. However, as seen by this chart, there is good news ahead of us. Because as you can see, most of the time when the Fed actually starts to cut rates or has signaled that the terminal rate has been reached, the Russell actually performs really well with an average return of 55%, for example, after the 1995 peak. Additionally, as it turns out, a slower pace of rate cuts from the Fed is actually a really bullish signal for stocks, because during fast rate cuts, typically that are signaled by a recession, there's clearly an economic issue that the Fed is trying to fight against and hence trying to stimulate growth, which obviously gets translated into the valuation of most stocks. But instead, if like right now, what we expect over the next 2 years, the Fed slowly cuts rates or keeps them stable, that is actually great news, because most of the time that is happening because of extremely good underlying fundamentals. And although the insane rally we've seen in the Fantastic Four, converted from the Magnificent Seven, is certainly a concern and could result in a short-term correction or pullback, what we are expected to see in the rest of the 493 stocks is something that is extremely exciting. Yeah, obviously nothing is guaranteed, and there's plenty of companies that are still unprofitable that you want to stay away from. But the reality is, as investors, it's been a really tough time for the past 2.5 years, not because of underperformance from businesses, but rather just a sincere increase in fear and portfolio write-offs for the smaller companies, even if they're not performing nearly as bad. It's been pretty well known that, small caps don't outperform the large caps over the long term simply because they're more risky, but at least in the short term, the valuations have been stretched so much to the downside that there is an opportunity right here, which in my opinion is something everybody should be paying attention to in 2024.